guys, welcome back. On today's class, we'll be talking about candlesticks. This is awesome. So, with no further ado, let's get into it. So, on the table of contents, we'll be talking about the introduction to candlestick analysis, the anatomy of a candlestick, the basic candlestick patterns, the single candlestick patterns, the multiple candlestick patterns, the candlestick patterns and trend confirmation, then trading strategies with these candlesticks, and we have the case studies and conclusion. Now, we're just going to have a snippet of the candlesticks. I wouldn't want to waste much time like I did in the last class. So we're going to talk about a candlestick. Now, what is a candlestick? A candlestick is a graphical indication of a representation of the price action in the markets. This is the simplest term in which I can explain it. Now, what does a candlestick look like? Now, the candlestick, it looks like this on the screen. The bullish candlestick comes in a green form, and the red candlestick comes in a red form. It's called a candle because it looks like a candle. And in this candlestick, we have the body and we have the wick. And for the bearish, we have the body as well, and we have the wick. And it comes with an upper wick and a lower wick. And for the bearish, it also comes with an upper wick and a lower wick. Now, the anatomy of a candlestick. So let's go into a proper breakdown of a candlestick with the body, wicks, and colors. So like I said, the green one indicates a buy candlestick. It means that if you see a green candle, it means the market is presently on a buy market, or on a buy trend, or on a buy system, or on a buy movement. And if you see a red candle, it means the market is currently on a sell system, on a sell trend, or on a bearish market. Now, these candles come in every time frame, from 1 second for people who scalp, for people who scalp in futures markets, like people who trade futures stocks like Tesla's, people who scalp from 1 second to yearly time frame. So the candles are representations of the hour of a specific time frame. So you can see like if it's a 1 second, if it's a 1 second time frame, then the candlestick represents a 1 second candlestick. If it's a 1 hour time frame, then one candlestick represents a 1 hour candlestick. If it's a 4 hour time frame, then one candlestick represents a 4 hour time frame or a candlestick. So when you see a candlestick, you need to understand what you're looking at, because it's very important to decode these candlesticks in order for you to be able to make a perfect execution in the market. Now, a candlestick has an opening session, it has an opening area, it has a close area, and it has a high and it has a low. Same thing for the bearish area. It has an opening, it has a close, it has a low, and it has a high. And if you notice, it's inverted and the opening is on the top, because of course, if it's bearish, you're starting from the top down because you're going downwards. So if you're going downwards, then it opens from the top. But if it's bullish, if you're going up, means you're starting from the bottom. It's like walking a staircase. If you're going up, you start from the ground to go to the next floor. And if you're going downwards, if you're going to the ground floor, you start from the top to the bottom. And that is why the open in the bullish is on the bottom, and the open on the bearish is on the top. So when you see a candlestick and you see a week means there was a specific time within the time frame. Now let's assume this is a 5 minutes candle. So it means there was a time within this 5 minutes that the price went below the opening price, and then obviously the bearish people pushed it below because it started here. So it's like starting on a first floor, and the bearish people pushed it below the first floor, trying to take it to the ground floor, but the bullish people rejected it and pushed it back, and the price went very high to the fourth floor, and the bearish people pushed it to the third floor. So you ended up sleeping on the third floor. So the 5 minutes candlestick closed here and it opened here. So this is the opening price and this is the close price. But a specific time within the 5 minutes time frame, it went below, which was close to the ground floor, and then within the same 5 minutes, it went to the fourth floor, but they ended up staying on the third floor. That's exactly what a week is. So a week, it means that if there was a specific time, the price went either above the closing price or below the open price. Now, it's the same thing as the bearish candle. A 5 minutes bearish candle, it opens on the top. There was a specific time the bullish people pushed it above, and then the bearish people rejected it, and then they pushed it below to the ground floor, and the bullish buyers or the buyers in the market rejected the price range and pushed it above to the first floor. And within the 5 minutes, it closed on this price area. And that's exactly what a candlestick is. So once you see a wick, you would know that there was a specific time the price went there, but the opposing buyers towards the candle. So if it's a bullish one, you see a wick, so you know the bearish people pushed it below, but the bullish people pushed it above. And if you see the bearish candle and it goes down, you know the bullish people pushed it above. And it's the same thing on the top. Now, basic candlestick patterns. So once you know what a candlestick is, you need to know there are specific candlestick patterns that influence the direction of the markets. And it signals a change of patterns, it signals a reversal, and it signals a continuation of a trend, and so on and so forth. And I'll be explaining to you these patterns. They are singular patterns and double patterns and triple patterns or multiple patterns. So example one, we have the classic, we have the long leg, we have the dragonfly, we have the four price, and we have the gravestone. And then we also have the hammer, and we have a shooting star. So this is an example of a basic candlestick pattern. So if you remember what I told you about the candlestick, you would understand that in a hammer, it means that the price opened at this area, the bearish people pushed it below, and the bullish people rejected it and pushed it back above and took it to the highest level, and then it closed without having a wick on the top. So it means it closed at its highest premium. And it's the same thing for the bearish. The bearish pushed it below, and then the bullish pushed it above, but because it was already on a bearish zone, it shows a red. It comes as a red candle, but it doesn't matter when this candlestick shows. It doesn't matter if it's a green candle or a red candle. They serve the same purpose. So we also have the shooting star, is the inverted of a hammer, is the inverted of the hammer. So the price opens here, and then the bullish people within the 5 minutes or 10 minutes time frame or 1 hour time frame push the price to this high, but the bearish people rejected the price, and then it closed here. And for the bearish candle, it opened here, and the bullish people took power and took charge to the highest, and the bearish people pushed it below, and it closed on that level. So that's exactly what a shooting star is. And the classic, it opens here. The bullish people push it above, but the bearish people pushed it below to this price, and then the bullish people pushed it, and then it closed. And then for the long legs, the bullish people, the price opened here. They went to the all-time high. The bearish people rejected it and then pushed it below, but the bullish buyers came in and pushed it, and then it closed on this level. So once you see candles like this, they are more of indecision candles. I will explain to you further in the slide. So we have single candlestick patterns. So examples of this single candlestick patterns are, like I had explained, the hammer, the shooting stars, and dojis. So a doji is more of an indecision candle. It means that both the buyers and sellers broke even. It's like the boxing match, when they win with a draw. So it means 50% buyers, 50% sellers, they broke even. And here they broke even, and here there was literally no movement at all, because where it opened and closed, they had no buying power or buying force. And gravestone it shows that the bearish people actually did push the market, but there was no convenient open or close within the area. So we're looking into this candlestick patterns and how it influences the direction of the markets. And this is for the example of the hammer. You can see once the hammer appears, it shows that the price was going down here and here. So these two candlesticks shows it's a bearish signal. And then the market, then it closes, the 5 minutes candle closes, opens here and closes here. And then the next one starts where it opens and closes here. And then the next candle opens here and try to go below, but the buyers rejected the price and pushed it above, and it closed on top. So it means that there are more buyers than sellers within the time frame. And it signals that there is the amount of buyers to sellers are more, because they were able to overpower the action of the sellers who are the bearish people, or people who short, or the shorters. And then the next candle opens on the top, and then it goes above, and then it closes on the same level where the other bearish buyers came in, and the next one. So when you see a hammer, you should be looking for a possible reversal. And if you see an inverted hammer, you should be looking for a possible reversal. So I don't usually care more about the names, because I feel like it's just a name. I actually look more into the idea of a candlestick. So I take it like 100%. So if this is 100%, right? Let's say this is 100%, and you have 100%. you have 100%, and then the price goes down. The price opens here. The bullish people took it above. The bullish people took it above. The bearish people pushed it below, but they couldn't push it below the closing. They couldn't push it so deep below the week, below the initial price within the previous time frame. So it closed here. So it closed little. So it means that, the bearish people have exhausted their power and they can't push it further down. And then the next candle opens above the area, giving it power to overthrow this other bearish people. And then it changes direction. So once you see a hammer, an inverted hammer, a dragonfly, a bullish spinning tap, a hanging man, a shooting stars, a gravestone doji, or a bearish spinning top, they indicate reversals. So they are signals of reversals. So you should be looking for these patterns when you are looking for a reversal, or you want to see a shift between a buyers to sellers or sellers to buyers. So unlike the single candlestick patterns, you have a multi-candlestick patterns. We have the double candlestick patterns and we have the triple candlestick patterns. So the first one we talked about, the single candlestick patterns, where we had the dragonfly, we had the hammer, we had the dragonfly, we had the doji, we had the spinning top. Here we'll be talking about the bullish engulfing and the tweezer bottoms. They are two candlestick patterns that shows a change of trajectory in the price or towards the direction of the markets. And the tweezer top and tweezer bottom typically indicates same low for bottoms and same high for bearish. So it means that the first candle opens towards the down direction. The second candle opens towards the down direction. And this is a bullish engulfing. And then the third candle breaks above the two candles. It means it's way stronger than the two candles. It indicates a strength for buyers. So once you see something like this, you should be looking for a long or a buy or bullish. It depends on the words or a grammatical ways at which you call a buy signal for yourself. And this is, you'll be looking for a long when you see a signal like this. And for a bearish engulfing, you'll be looking for a short when you see a signal like this. It's just an inverted version of a bullish engulfing. So it opens for a buy, one opens for a buy, two opens for a buy on a higher position, but the third one sells below and breaks the two bullish candles. So it automatically shows a greater strength with the bearish or the sellers. And for the tweezer bottom, it shows that there was a very strong bullish trend and then it's suspended. It's more like a support and resistance area where the price doesn't go below despite the strength of the previous sellers, and then it suspends because the buyers are forcing the markets. So the sellers push to this extent within the time frame. The bullish people push it above. The sellers push it, but they couldn't achieve much because this is like, let's say this is a 100% candle and this is a 40% candle. So it's way below average. And then the next 5 minutes time frame or the next 1 hour candle pops up open and it starts on the same level, and then they try to push it again below, but they couldn't even push it below. It still stays on the same length. So it automatically shows an exhaustion. It shows an exhaustion of sellers. It means there are no more sellers in the market and you should be looking for a possible buy because they couldn't push it below, because the point of selling is to push it below. And if they cannot push it below anymore and it's been exhausted, it means that there's a possible signal for buy. And you see the next candle after the exhaustion shows that there is a bullish confirmation, and automatically is a change of pattern. So you'll be looking for a buy, and if you look for a buy, you'll be able to acquire more pips and make more dollar. And for the twisted top is the inverted, same thing. You have a bullish candle, 80, let's say 80%, and then you have the next bullish candle, let's say 40%, and then they tried to go above, but the sellers came into the market and pushed it and closed at 40%. And then the next candle opens within the minutes, within the hour, within the months. It depends on the time frame of this candlesticks. And then the sellers try to push it above. Now the sellers try to push it below, but the buyers are still in the market trying to see if they could still keep buying this, the market. And then they try to push it back, but they couldn't break past the level at which the sellers overthrown them. And then they close at the same range at where the sellers became present. So it shows a weakness in buying. So automatically, when you see something like this, you should be looking for a sell. And then you can see afterwards, the next candle comes as a sell, and it's quite dominating that it beats the previous candle. So that is exactly what a twisted top looks like. So they're just reversal candlestick patterns that shows strength of the candles. And I prefer to read the candles towards the way I explained to you. Look at it as a number, as a percent, 100%, 40%, 30% is much better. So if you're seeing something bigger, an 80 to 60, obviously 80 is bigger than 60. So if it's an 80 bullish and a 60 bearish, the bullish people are still more possessive in the markets because they are 20% stronger than the bearish candle you can see. And you need to be way over 80 for you to know that the change of power has occurred. So another multiple candlestick patterns are the 3 black crowns, the 3 white soldiers, the morning star, the evening star, the 3 inside up, and the 3 inside down. So the black crowns are something like an indecision candle. It's more like an indecision candle, but it's not as slim as the indecision candle, and that's why I say I prefer to look at it as a percent than look at it as a name, because I wouldn't understand what I'll be doing with a hammer. Like, okay, I see a hammer, and then because of a hammer I'll buy, of course, but it's a name, of course. Like, everything has to come with a name, because like in the world everything is described towards something, and it obviously has a way of identification. So if we look into the 3 black crowns, you would be able to see on the left side, you can see that we are in a bullish momentum. So you see the candles are pushing towards the upside, and then the bullish candles are pushing toward the upside in a good form. So we're looking at, let's say we're looking at 70%, 70%, 70%. And then the next one comes and it's below 25%. And it's not as powerful as it should be. And the next candle comes and open below. Like, it comes and open below the 25%, which was poorly driven in the market. And then it opens with a bearish of 70%, canceling the previous one, canceling the previous bullish. And then the second one opens with a 70%, canceling the other previous bullish. And the next one opens with a 70%, canceling the last previous bullish. So obviously, it shows that there is a change of trend. It means that you are in a bearish trend now, and you should be looking for a sell, because it's has cancelled every movement that the bullish or the buyers have done in the market. So it means that either the buyers have taken profits or more sellers have come in the market to overthrow these buyers. So the buyers who had gotten to that point will be selling as well. So it's best for you to find a sell or sells. It's best for you to find a sell entry at this point. And the three white soldiers are the same thing. They're the inverted. So you have the sellers in the market and a 25% or an indecision candle where the candle did poorly. The movement of the candle did poorly. And then the next three candles did brightly in the opposite direction, means the buyers were much more positive and they came with a greater force to overpower the bullish people, the white soldiers, the bullish people. And the same thing as the morning star. You have the bearish signal, and then you have the indecision that levels the playing field. And then the bullish opens just above it, and then the next one cancels a greater level of the bearish zone. So if you see a morning star, you should be looking for a buy. If you see an evening star, you should be looking for a sell. The same thing as the tree inside up. You have a bearish, you have a 60, 25, 60, 80%, and then you have a 60%, and then you have an 8, you have a 70%. So a 60 plus 70 is 130, and a 30 obviously beats this 80. So automatically, if you see these three signals, you would know that there's a change of power at hand, and you'll be looking for a buy. And it's the same thing for the tree inside down. You have a bullish signal, and then you have a bearish change of power. And that is exactly what a multi-candlestick pattern basically is. So in my previous class, I talked about trend lines. If you haven't watched it, I know it's long, and that is why I tried to rush this one. It's very good you also go back and watch trend lines, because I can't go through every part of it because it's long and it's too much to go through. So this is an examples of where you can see these chart patterns, this candle patterns, in the market, and they come in areas like the pivotal areas, support and resistance areas, major zones, major high swing zones, and low swing zones. So you'll be looking for candlestick patterns in a bigger time frame, or you'll be looking for them in support and resistance areas. So here we have an example of a tweet setup, which shows a bearish signal. And here you can see there's a big bearish signal, a big impulse movement on a bearish signal. And in this area here, we have an evening star. So literally, candlestick patterns can actually help you, direct you, and give you an indication for either a buy or a sell bias in the market. Now, trading strategies with candlesticks. Now, the common mistakes in candlesticks people make with these candlesticks is that you try to find meaning in every candlestick that appears on the chart. I mean, there are lots of times markets are noisy, and not every candlestick is useful. Please, not every candlestick is useful. You focus on the important candles and areas where the markets are trading, like support and resistance, or psychological levels, or key zone areas like swing highs and swing lows. You identify where you feel these levels are, and then look for candle patterns there. So sometimes your imaginations are too strong. You zoom into the market a lot, and you try to see things that are not there. If you cannot see these candlesticks, they are not there. You don't need to convince yourself that they are there. Please. It's very important that it's visible. Like I said in the trend lines, if you can't see it, it's not there. The market knows how to play with your psychology for you to forcefully believe something is there. Sometimes your imaginations are too weak that you expect it to come as a textbook. Sometimes these candlestick formations can come in 5 candles instead of 3 candles. And because you're used to a 3 formation, you ignore the signs of this Twitter top, spinning top, the hammers, and so on and so forth. And you don't wait for a confirmation. So these are the common mistakes. So when people see these trends, they see these candlesticks, they automatically jump into a buy or a sell because they are looking at, a 3 white soldiers, or they're seeing a Twitter top and they automatically jump into a buy or sell bias. No, you have to wait for a confirmation. You have to wait for the next candle to form and see the strength of the candle to confirm your buy and sell bias. Thank you, and I'll see you in the next class.